Today, we're diving headfirst into something you've almost definitely heard about. It's everywhere, right? Financial news, maybe social media, even just friends chatting.
Hmm.
The S&P 500. You know the name, sure, but what is it, really? And, why does it seem to hold so much power in the financial world? So our mission today is basically to pull back the curtain on the S&P 500. We'll try to demystify what it's actually made of, understand its influence, which is pretty profound, and explore why it's such a key benchmark for investors, really, all over the globe. And we got a great mix of sources, everything from detailed financial wikis to some really practical YouTube guides. So, yeah, proper deep dive tailored for you.
Exactly. And I think what we'll find is that the S&P 500, it's much more than just, a list of companies. It really acts as a window into the health of the U.S. economy, a big one. And it's also a powerful tool for, strategic financial planning. One source actually gave this great analogy to picture it. Think of the S&P 500 like a big dynamic school of maybe 500 large, healthy dolphins swimming freely in the ocean.
Okay, dolphins. I like that.
Yeah. Each dolphin is a powerful company shaping the currents.
Yeah.
And together their movement tells us a lot about how healthy that whole ocean ecosystem is.
That's a fantastic image. It really makes something potentially complex feel, well, much more graspable straight away.
Okay.
So let's start with the absolute basics then, for you listening. When people say the S&P 500, what exactly are they talking about?
Okay, so at its very core, the S&P 500 is a stock market index.
Hmm?
Simple as that, initially. It was developed by Standard & Poor's, the credit rating agency.
Right, S&P.
Got it. And what it does, essentially, is track about 500 of the largest, most influential companies publicly traded in the U.S. These are companies on the big exchanges, the New York Stock Exchange, NYSE,
Yep.
NASDAQ, and also the CBOE, the Chicago Board Options Exchange. And the scale of it's genuinely remarkable. It represents over 80% of the total market value, the market capitalization of all U.S.-listed companies.
80%. Wow.
Yeah, it's huge. So it's not just an indicator. It often drives market sentiment globally. It influences corporate decisions, consumer confidence, everything. It's really considered the de facto benchmark for the U.S. stock market.
And it's not like it's been around forever, right? It has a specific starting point. I thought this was interesting. It first launched March 4th, 1957.
That's right.
And what's really fascinating is how they set the starting value, the base value of 10. They used the average market cap of the stocks back in, get this, 1941 to 1943.
That historical baseline is quite telling.
What does that long view tell us? Does it speak to its stability or?
I think it does. It points to that long-term perspective it aims for. And just to clarify something important, that 500 isn't just any 500 companies pulled out of a hat.
Right, it's selective.
Very selective. It's a bit of an exclusive club, really. To even get considered, a company needs to be U.S.-based, obviously, listed on one of those eligible exchanges we mentioned,
Yep.
have a market cap of currently $14.5 billion or more. So pretty big. And crucially, it must have been profitable over the last 4 consecutive quarters, so the last full year.
So consistent profitability is key.
Exactly. It's a tough standard. It ensures the index really represents the top tier of American business.
Okay, so we've got the definition, the history, the selection process. Pretty clear. Now, let's pivot to maybe the most important question for anyone listening. Why should you care about the S&P 500? Especially if you're not, say, glued to stock tickers all day.
Well, connecting to the bigger picture again, think of it as that barometer for the whole U.S. economy's health.
Right, the dolphin school analogy.
Exactly, like that vibrant dolphin school signaling a healthy ocean. A rising S&P 500 generally points to economic growth. Things are looking up. A decline, on the other hand, might suggest challenges ahead. Its movements really reflect those broader economic currents affecting jobs, interest rates, all sorts of things.
And beyond just the economy in general, how does this connect to your actual money? Say, if you mainly use savings accounts, well, it really comes down to inflation, doesn't it? That slow erosion of purchasing power.
One of our sources used a simple example, like a 5,001 coffee. That same 5,001 today just won't buy the same amount of coffee in 10 or 20 years.
It buys less and less.
Exactly. And that's not just about coffee, obviously. It hits your long-term savings hard, especially when you think about retirement, which actually leads to a really interesting comparison about future planning.
It does. It really
Right.
makes you ask, are you, truly prepared for the long haul, especially retirement? If you look at average annual returns for pension funds in many developed countries, they're often in the, say, 5 to 10% range.
Okay, that sounds decent.
But then compare that, for example, to Korea's historical average, which has been closer to maybe 2%.
Oh, wow. That's a big difference.
It's a huge difference when you compound it over decades. It creates a massive gap in potential wealth. It really underlines the need to find ways to preserve and ideally grow your wealth more actively than just letting inflation chip away at it. Absolutely. And that's where something like the S&P 500 can come in, even if you're just building a basic portfolio. It offers stability and diversification. I love this analogy from one source. Think of the S&P 500 as the ramen seasoning for your investments.
Huh. Ramen seasoning, I like that.
Yeah. What they meant was it's got this built-in mix, right? Growth stocks, value stocks, dividend payers across all sorts of sectors.
Diversification built in.
Exactly. So if one company or even one whole sector hits a rough patch,
The whole thing doesn't necessarily tank.
right, the overall impact on your investment is cushioned. It's like that reliable foundational flavor,
Yeah.
broad, resilient exposure, much like our dolphin school provides that core strength.
That ramen seasoning analogy really works, doesn't it? Okay, so let's dive a bit deeper now. How does this index actually work under the hood? What's really fascinating and key to understand is that the S&P 500 isn't just a simple average of 500 stock prices. It's what we call market capitalization weighted.
Okay, market cap weighted. What does that mean in practice?
It means the bigger the company's total stock market value, its market cap, the more influence it have on the index's movement. So giant companies like, say, Apple or Microsoft,
The big players.
they have a much, much greater impact on where the S&P 500 goes day to day than the smaller companies in the index. It's just like in our dolphin school analogy, the biggest, strongest dolphins have more sway over where the whole group heads.
Right. Their movements really steer the index.
Exactly, which leads to some interesting dynamics.
You mentioned those big, strong dolphins.
Sure.
Who are some of the current leaders then? The ones really driving things? Our sources listed some top names as of March 2025. You've got the usual suspects, right? Apple, Microsoft,
Yeah, the giants.
NVIDIA, Amazon, Alphabet, that's Google, of course, Meta, which is Facebook, Berkshire Hathaway, Tesla.
A powerful lineup.
Definitely. And what's really striking is how concentrated that power has become. Those top 7 companies, people are calling them the Magnificent Seven now.
That term's everywhere.
By 2025, they apparently accounted for something like 32% of the S&P 500's total weight.
32% from just 7 companies.
Yeah. That's some serious concentration, isn't it? What are the sort of implications of that for an investor?
Well, it's definitely a double-edged sword. On one hand, it reflects the incredible success and innovation of these specific companies. But on the other hand, it means the index's overall performance becomes much more tied to the fortunes of just a few names.
So, more sensitive to news about them.
Exactly. If one of those giants faces, say, regulatory issues or a big product miss, it could potentially increase the volatility of the whole S&P 500. Even if, the other 493 companies are doing just fine, it's definitely something to be aware of. And this concentration ties into another key point. The S&P 500 isn't set in stone. It's not a static list.
Ah, right. It changes.
It's dynamic. It undergoes rebalancing, usually quarterly. So the committee looks at the companies regularly as businesses grow or shrink or maybe merge. New companies get added and underperformers get removed.
Like new baby dolphins joining the school and older ones leaving.
Precisely. And getting added to the S&P 500, that's a huge deal for a company. It's
Yeah.
often seen as a major positive catalyst. Why? Because all those passive index funds and ETFs that track the S&P 500,
They suddenly have to buy the stock.
they're obligated to buy it. Exactly.
Yeah.
Which drives up demand, helps with future funding, increases visibility. It's a big boost. This constant refreshing is really key to its long-term relevance and resilience.
That makes sense. It adapts. And it's worth remembering, too, the S&P 500 is just one piece, right? Part of a bigger family.
That's right. There's also the S&P 400 for mid-sized companies,
Mid caps, yeah.
the S&P 600 for smaller companies, small caps, and then the S&P Composite 1500, which basically lumps them all together.
So it covers the whole spectrum.
Pretty much the whole U.S. stock market landscape, yeah.
Okay, this is great. We understand what it is, how it works, the weighting, the rebalancing, why it matters. So the really practical question now for you listening, how can you actually invest in this thing? How do you get exposure to the S&P 500?
Right. The main way, and certainly the most common for individual investors, is through exchange-traded funds, ETFs.
ETFs, okay. Heard of those?
They're basically investment funds, but they trade on stock exchanges just like individual stocks. Easy to buy and sell. But instead of holding one company, an ETF holds a whole basket of assets. And in this case, S&P 500 ETFs are specifically designed to track the performance of the S&P 500 index.
So they try to mirror its returns.
Exactly. Think of them like those small, fast fish we mentioned, diligently following our dolphin school.
Okay, the follower fare.
Yeah. Buying one share of the ETF gives you instant exposure to all 500 companies, or close to it, in the right proportions. It's very convenient.
That sounds much easier than buying 500 stocks individually.
Oh, definitely.
And there are quite a few options out there, right? For U.S.-listed ones, people might see tickers like SPY, VOO, IVV.
Those are the big three, yeah. SPY, VOO, IVV. They're huge, very popular, and honestly, the differences between them are pretty minimal. We're talking tiny variations in fees, maybe slight differences in structure, but they all track the S&P 500 very closely.
And what about for investors outside the U.S., like, say, in Korea? Are there local options?
Absolutely. You'll find domestically listed ETFs in many countries that track the S&P 500. In Korea, for instance, you've got names like Codex US S&P 500, Tiger US S&P 500, Rise US S&P 500, 8 US S&P 500.
Okay, similar names.
Yeah, they aim to do the same thing, track the index. You might find slightly bigger differences between these domestic ones compared to U.S. giants, maybe in fees or tracking error, but they offer local access.
So when you're choosing one of these ETFs, what should you look out for? What are the key things to consider?
Good question. A few crucial points. First, and maybe most obvious, are the fees. This is usually called the expense ratio, or sometimes the GER, gross expense ratio.
Right, how much they charge you.
Exactly. It's a small annual percentage the fund manager takes to cover costs. With the big S&P 500 ETFs, these fees are typically very low. Like SPY, it's around 0.0945% per year. That's less than a tenth of 1%.
Tiny. Like a little bit of bait for your tracking fish.
Haha, yeah. Just enough to keep them swimming effectively. Low fees are really important for long-term returns. Second big thing is currency hedging. This gets a bit technical, but it's important.
Okay. Hedged versus unhedged.
Right. You might see an H in the ETF name. That means it's currency hedged. It tries to remove the effect of the exchange rate changing between, say, the US dollar and your local currency, like the Korean won.
So it isolates the stock performance?
It tries to, yeah. Unhedged products don't do this. You're exposed to the currency fluctuations. Interestingly, a lot of advice actually leans towards unhedged for long-term investing.
Oh, why is that?
Because sometimes, when global stock markets fall, the U.S. dollar strengthens. So that stronger dollar can actually cushion some of the losses for an international investor holding unhedged U.S. assets. It acts like a sort of natural hedge.
That's counterintuitive, but makes sense.
It can be, yeah. Something to consider based on your own view and risk tolerance. And one more thing, TR or total return products.
TR, okay. What's that?
These ETFs automatically reinvest the dividends paid out by the companies in the index back into the fund.
Instead of paying them out to you as cash.
Exactly. This can be beneficial, especially from a tax perspective in some countries, as you might defer or reduce tax on dividend income. And maybe the most vital piece of practical advice, especially for beginners or anyone looking to maximize efficiency, is to prioritize using tax-advantaged accounts first.
The tax benefits are huge there.
They really are.
You know, speaking of financial wisdom, it's not just us saying the S&P 500 is important. The ultimate investor, Warren Buffett, is a massive fan.
Oh, absolutely. He's probably the biggest cheerleader.
He famously said he told his wife to put, 90% of her inheritance into a simple S&P 500 index fund.
90%. And the other 10% in short-term government bonds.
Right. And he constantly tells everyday investors basically the same thing.
Yeah.
Just put your money in the S&P 500, forget about it, and go back to work. Focus on what you do best.
It's powerful advice coming from him, and the historical performance really backs it up. What's really fascinating when you look at the numbers, since it launched back in '57, the S&P 500 has delivered an average annual return of roughly 11%.
11% average per year over decades? That's pretty compelling.
It really is. And maybe even more impressive is its resilience. Historically, even after really nasty market crashes, think the dot-com bust, the 2008 financial crisis, it has always eventually recovered to its previous high point. On average, it's taken about 7 years and 6 months to fully recover from major downturns.
Always recovered eventually. That's a key point for long-term thinking.
Absolutely. It demonstrates that dynamic nature we talked about, shedding the old, embracing the new, and reflecting overall economic progress. It rewards patience. However, and this is a big however, while the long-term trend is up, you absolutely have to acknowledge the short-term risk.
Right. It doesn't go up in a straight line.
Not at all. Our sources point out it has fallen by as much as 50%, cut in half during major crises.
50%, that would feel terrifying in the moment.
It is terrifying. I mean, think back to the early days of the COVID pandemic crash. The headlines were brutal. It's easy to say stay the course when things are calm, but much harder when your portfolio is plunging. So it really raises that important question. How do you mentally prepare for that kind of volatility? How do you stick with your long-term plan when your gut is screaming sell?
Yeah, managing the emotional side is key.
Definitely. And for people looking for maybe a bit more stability, especially for really critical long-term money like pensions, one strategy is to combine the S&P 500 with other types of assets, like gold or bonds. Asset allocation, diversification beyond just stocks. Exactly. These assets, gold and bonds, often have what's called a low correlation with stocks.
Meaning they don't always move in the same direction.
Right. Sometimes when stocks are falling sharply, gold or high-quality bonds might hold their value or even go up. They can act as a defensive buffer.
So smoothing out the ride a bit?
Precisely. It helps diversify risk across different asset classes, not just different companies. It adds another layer of potential stability, which can be really valuable for peace of mind and protecting capital during downturns.
Okay, fantastic. We have covered so much ground here. So just to recap for everyone listening, what does this all mean? Today, you've really gotten under the hood of the S&P 500, what it is, why it's such a critical indicator and a powerful tool for investing, how you can actually invest in it, especially thinking about those ETFs and the crucial role of tax-advantaged accounts using domestic options, and even touched on some more advanced ideas like asset allocation for stability. It's been a real deep dive.
It has. And maybe a final thought to leave you with. Considering everything we've discussed, the S&P 500's historical resilience, its deep connection to U.S. economic growth, how it constantly incorporates leading global innovators, reflect on this. The index isn't just a rearview mirror, just measuring past performance. It's potentially a powerful engine for future wealth creation, tied to ongoing innovation and technological advancement. So how might really understanding this index, its role, and its potential, how might that shape your own long-term financial outlook and even how you see your participation in the wider global economy?
That is a really powerful question to ponder, something to definitely think about long after this conversation ends. Thank you so much for joining us on this deep dive into the S&P 500. We genuinely hope you feel more informed, maybe more confident about this really essential financial benchmark. Keep diving deep into the world of finance.